looking at the determinants of interest rates, the government, the Federal Reserve, has a very big impact. They can control short-term interest rates by lowering or raising the federal funds rates. Now, honestly, that rate doesn't impact many people, but it's a sign of what the Fed is going to do. So it's taken very seriously and has a pretty big impact on the overall market. If you think interest rates are going to rise in the future, you are going to be very reluctant to make long-term investments. When you do think interest rates are going to rise, and believe me, at this point, with low interest rates, everybody thinks interest rates are going to rise, then long-term interest rates will tend to be higher than short-term interest rates in order to get more people to be willing to lend money. And again, the opposite if you think interest rates are going to fall. Now, the Fed is important not because it changes the federal funds rate. That discount rate really isn't too relevant. You know, hardly anybody borrows from the Fed, but that tells you what you think the Federal Reserve is going to do. It pretty much has to stay in line with the 3-month Treasury bill, the short-term risk-free rate of government lending. The Fed has much more power in its control over the monetary base. That's the sum of currency in circulation, vault cash, member bank deposits. They can increase the monetary base by buying bonds in the open market, and they decrease the monetary base by selling bonds. Now here's a picture of short-term versus long-term and recessions. Those gray bars are recessions. Again, we had the Great Recession most recently that all of you experienced. You can see we regularly have recessions, but not necessarily all of the time. And also we can see how much higher, incredibly higher, interest rates were in the 1980s than they are now. Again, a steady downward trend from the 1980s until now. The level of interest rates does tend to rise and fall with the actual rate of inflation, and it tends to rise during periods of economic expansion and decline during periods of economic contraction. However, again, the trend more recently has simply been declining. Sometimes we just refer to the opportunity cost as the cost of capital, and it is the discount rate that we have been using in these present value calculations. With opportunity cost, you are asking the question, what else could you be using the money for? Something else that's of the same time period and the same risk level. What alternative uses do you have for your cash?